Well, good afternoon. Happy Friday, January the 29th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. So rates still remaining very low, near historic lows, although not quite there. January has really been a tale of 2 months in one 30-day period. We started out the year really at the best levels of all time, only to be immediately smacked in the face as the Georgia senatorial runoff really sent the markets into a bit of a tailspin, and bonds started to sell off. We started to see mortgage-backed securities sell off, which means rates were headed much, much higher. We've actually gained back about half of what we lost there in terms of pricing power. So rates have actually improved since about mid-month in January as we round out the month here. Now this week, the Fed met in a regularly scheduled meeting on Tuesday and Wednesday, the Fed announcement coming Wednesday afternoon at 2 p.m. Eastern time, and largely uneventful, probably one of the most uneventful Fed announcements that we've had in quite some time. The Fed announcing that it's going to leave the Fed funds rate unchanged. That's no surprise to anyone. No one was expecting the Fed to do much with the Fed funds rate, but certainly we're paying attention, as we always do, to the language from the Fed. The Fed keeping up their pace of purchases of treasuries and mortgage-backed securities, $80 billion per month in treasuries, $40 billion per month for mortgage-backed securities, totaling up $120 billion per month in Fed asset purchases. No signs of that stopping anytime soon. The Fed did allude to seeing that growth is moderating or growth is slowing, which is a concern, right? The Fed is trying to spur the economy. That's the whole reason for the asset purchases, is to keep those interest rates low in hopes of spurring the economy, and we're just not seeing it yet. Of course, all of this still centered around the virus, around the global pandemic, and really the ineffective campaign for the vaccine thus far. We've seen a lot of problems, supply chain problems in particular, just getting the vaccine out to the populace. And really until that changes, until we see some sort of widespread vaccination that's happening and that trickles down into the overall economy, we're going to be in this territory. We're just sort of going to be languishing a bit, trying to find our footing based upon economic data, based upon the progression of the virus, and based upon the actions of the Federal Reserve as it pertains to these asset purchases. You may have been reading this week about a lot of stock market volatility involving short selling with GameStop, Bed Bath & Beyond, AMC Theaters. Anytime there's that kind of volatility, we might see some short-term upsets, improvements, or degradation in mortgage bonds. These are usually short-lived, though. We're literally talking about just intraday movement, nothing that's going to set us off on a particular trend for long-term rate change. So still at relatively great levels. You'll find the 30-year fix somewhere in the mid-twos. You're going to find 15-year fix down in the low twos for conforming conventional. Jumbo is always slightly different than that. And of course, government loans still down in the low twos as well. If we can be of any service to you, please don't hesitate to reach out. Mark.Milam@highlandmtg.com, 404-395-1102. Have a good weekend, everybody.